The Boston University Global Development Policy Center is a university-wide research center that works to advance policy-oriented research for financial stability, human well-being, and environmental sustainability across the globe. My name is Bill Kring. I'm the Executive Director at the GDP Center and pleased to join all of you today. The global financial safety net, or the set of institutions that are designed to provide liquidity and mitigate impacts of financial crises, is unequal and largely inaccessible for lower-income countries. In particular, the International Monetary Fund, or the anchor of the global financial safety net, is facing a crisis of legitimacy as it completes its 16th General Review of Quotas, the process that is intended to ensure that the fund is a governance structure aligned and resources aligned with the realities of the current global economy. Yet following the 2023 IMF World Bank Group annual meetings in Morocco, it appears that little to no progress will be made during this quota review cycle. While the IMF may increase its firepower with an equiproportional increase of quotas across all member countries, it will reduce its temporary sources of liquidity, resulting in no net increase. Doing so risks perpetuating the inequalities in IMF governance that leaves emerging market and developing economies underrepresented in the decision-making process of the fund. So what is the current landscape of the global financial safety net? What are its shortcomings? What is needed to rebalance the GFSN to ensure accessibility for countries of all income groups? The 16th General Review of Quotas doesn't deliver realignment at the IMF. What can be done ahead of the 17th review in 2028? A new update to the Global Financial Safety Net Tracker, co-produced by Boston University Global Development Policy Center, Free University Berlin, and the United Nations Conference on Trade and Development, provides some key insights on the current state of the global financial safety net, lending capacity, and more. The GFSN tracker is the first global interactive database that measures the annual lending capacity of the IMF, regional financial arrangements, central banks, and the total amount of financing to combat the COVID-19 crisis via loans from these institutions. Today, I am pleased to be joined by Mary Lou Wee, a non-resident senior fellow for the Global Economic Governance Initiative at the GDP Center. Previously, she was the director of the Secretariat of the Intergovernmental Group of 24 on Monetary Affairs and Development. She is also a member of the Task Force on Climate Development in the International Monetary Fund, a consortium of experts working to advance development-centered climate policy at the IMF with rigorous empirical research. Barbara Fritz is also joining us, a full professor at Free University Berlin with a joint appointment at the Department of Economics in the Institute for Latin American Studies. Her fields of expertise are development economics and international macroeconomics, with a special focus on Latin America. Barbara has published widely on regional financial arrangements, the global financial safety net, capital account regulation, currency hierarchy, and inequality, among many other topics. We are also joined by Marina Zucker-Marquez, a postdoctoral researcher for the Debt Relief for a Green and Inclusive Recovery project at SOAS, University of London. Previously, Marina worked at the United Nations Conference on Trade and Development in the Debt and Development Finance branch, Globalization and Development Strategies. Marina holds a PhD from Free University Berlin. Before opening the discussion, I want to mention that this webinar is being live streamed on YouTube, so a recording will be immediately accessible after the conclusion of today's discussion. Please use the Q&A box located in your Zoom menu to ask questions, and also please provide your name and affiliation so that I can give you attribution for your question. We'll take questions after an initial discussion, but please feel free to enter your questions at any time as they arise during the webinar. We'll first have Barbara present some key findings from our newly updated Global Financial Safety Net Tracker, and I'll provide a brief demonstration of the interactive. Following that, I have some questions to kick off the discussion with each of the panelists, and we'll open to Q&A. Barbara, over to you.
Thanks a lot. So could you share the presentation? Cool. Okay, thank you. So glad to be here and to present the new version of this Global Financial Safety Net Tracker and the first results. So go to the next slide, please. what is the global financial safety net? It is a set of institutions which provide short-term finance to countries which are in financial crisis. It has, as you can see, changed dramatically over time. It just started with the IMF, the small green dot in green in the Bretton Woods era, but already in the 70s, a set of regional financial arrangements in red were created in different regions of the world. And their countries pool their foreign exchange reserves to help each other in times of crisis. Now, what we have is a big complex system with a third new element in blue, the bilateral central bank currency swaps. Here, two central banks do agree for a certain time and for a certain volume to lend to each other in their own currency when the other central bank is in need. We see that in total today, the global financial safety net brings together 3.5 trillion US dollar, which is a large sum, 4% of GDP, of global GDP. And we also see that the IMF is no longer the only player in the field. Next slide. What I will present in the next minutes is based on the data we collected for the Global Financial Safety Net Tracker, which Bill will introduce in detail in a minute. So go to the next slide to the first results. Here, what you can see is the lending capacity of the global financial safety net per income groups, measured as a percentage of GDP per country for the years 2018 to 22. And first we go to the right-hand group, the high-income countries. You see that they have the highest access to lending capacity of the GFSN of all the country groups. And they also have a much higher variety of GFSN finance. Their main source is the red one, is regional funds, which is dominated mostly by the large European stabilization mechanism. Also the blue one, which are swaps, especially the unlimited swaps for selected high-income countries. The Federal Reserve has provided a network of unlimited swaps in terms of time and volume to ECB member countries and to the Central Bank of Switzerland, England, Canada, and Japan, which we measure here only in the actual use of lending, but in fact, they are infinite. Next slide. The low-income countries, the left-hand group, has much less varied access to GFSN lending. You see mostly green, which is IMF lending. And the dark green here is conditional standard IMF lending. But you see that in the COVID period of 2020 to 22, you see also the increasing share of the light green bar, which is unconditional emergency finance from the IMF, which all countries received along their quota, all IMF member countries, but for the low-income countries, this has been over proportionally important because they have so little access to other sources. Next, we see that the lower and upper middle income countries are those which are the least covered in terms of their GDP by the all elements of the global financial safety net, even if we see a somehow higher variety in terms of access also to RFAs and to swaps, still the IMF is an important player here. Next slide. So in a recent policy brief published by Marina Zucker, which is here, and Larissa Möhlich, which is one of the key authors of all this work of the Global Financial Safety Net Tracker and all the analysis we have been doing here, the two have calculated the necessary amount to equalize the excess of crisis finance in the GFSN. So what you see here are the three boxes for the three income groups, which sum up the volume, and you can see that especially, and this is always compared to the excess high-income countries have in the global financial safety net. So in order to achieve a similar level as high-income countries, the lower and middle-income countries should have a very high additional access by the IMF. What Larissa and Marina calculated here, that the IMF should increase its lending capacity to balance the inequalities of the global financial safety net towards low and middle income countries on the basis of a 127% quota increase, or by 550 billion US dollar. From these $550 billion, 8 billion would go to low income countries and the rest would go to middle income countries. And then they would be equal. Next slide. Now I go at a last point to the current use of the GFSN as we track it in our tracker. You see that over the period of 2020 to 23, the use has been varied, as always. But we see a peak of demand of unconditional IMF lending in 2020, especially by low-income countries. So this new source of the IMF, which increased its lending on non-conditional terms in the COVID crisis, is something very welcome by low-income, especially by low-income countries. For the rest, it's rather similar. 2003, the volume seemed to be different because here we measure it monthly and not quarterly as in the previous years. Last slide now. So what are the conclusions we draw with regard to the IMF? The 50% quota increase, which is planned at the current reform, seems to be by far insufficient to equalize access of all country groups to the global financial safety net. It should be more than double. But also the quality of IMF lending is important. The IMF has ceased to provide this large share of unconditional lending in the beginning of this year, but we see that demand is high. So the IMF should turn back to unconditional emergency lending. And third, there's a huge need to coordinate the GFSN. The IMF is not any longer the only player in the field, but it should cooperate with the other, but it should have a coordination role at eyes level with the other elements, the regional funds and the swap providing central banks, because they have their comparative advantages. And an important role for the IMF should be to bring all these actors to the table, to share information, to create transparency, to coordinate when they're lending on terms, etc. Thank you for this. I hand back to Bill.
Thank you so much, Barbara, for that important overview and context. All right, allow me to share my screen here. All right. So the Global Financial Safety Net Tracker has been around for a number of years now. But really what it's undergone with this most recent launch is a robust increase in the user interface and in the ability to filter, sort, and navigate through the data. So I'm going to briefly provide an overview of how to navigate and utilize the tracker before we continue our discussion with the implications of the data released with this update. So when you arrive at the home page of the tracker, you'll notice two tabs that we'll get into in a moment. But first, we'll just discuss the usability of it. So the two tabs function virtually identically in terms of navigation and the filtering of data. First, I'd like to draw your attention to the ability to zoom in and zoom out, and to also drag across the screen by pressing with your cursor and dragging across the map. This allows users to compare regions or to look at the distribution of funding, or to get a closer look at subregions by zooming in. So you can zoom in and zoom out at any point by clicking the globe. It will bring you back to the overall map view. In addition to this new feature, we've added new filters that are on this left side legend of the screen. So you can filter by type of liquidity access simply by toggling on or off for the button on the screen. This allows users to really get a good sense of the breakdown in distribution of the different types of funding. But despite filtering for this, the tooltip, which is visible when you hover over a particular country still allows you to see the other types of funding that are available. And for comparative purposes, you can also lock the tooltip by clicking on it and holding, and then clicking outside of the tooltip at any time to eliminate that view. I guess now what we'll talk about is the two tabs. So the lending capacity tab, which is the current tab that we're on, this shows a country's access limits to various components of the global financial safety net. The data shown reflects the maximum crisis financing that is potentially available to a country from RFAs, the International Monetary Fund, or swap arrangements. And below the map, you can see a data breakdown that's provided by country. It allows you to see the income group of the country, GDP, and then the amount of access available under each component that our tracker tracks. And a blank entry, of course, reflects that type of access, liquidity access, is not available. The second tab that we have is the COVID-19 financing arrangements tab. This tab, which has the same navigation and legend on the left for filtering, displays the total amount of financing from these three sources that were deployed in response to the COVID-19 crisis. Below the map, we have a bar graph depicting the number of agreements quarterly since 2020, and the breakdown of data in the table below follows as well, showing the date of the arrangement, the issuer, and the amount. Finally, for more information on the data, you can click the About tab. This provides background on each of the tab, key definitions, some key resources. And if you scroll all the way down, there is a data download form that you can complete and get a direct download after validation of the data directly from us. In addition, we always welcome feedback and insight and general inquiries. So we provide an email here, the GFSN tracker at bu.edu, and an email on this page as well for press and media inquiries. I will stop sharing now, and we will continue with the discussion. So first, Mary Lou, Barbara referenced in her presentation what the IMF can specifically do to fulfill its role as an anchor of the global financial safety net. Can you connect this conversation to the ongoing 16th General Review of Quotas? As we think about reforming the GFSN and the international financial architecture more broadly, what key considerations are important moving into the 17th General Review of Quotas set to conclude in 2028? And specifically, the IMF agreed to set a target of 2025 for proposals on a new quota formula. As countries get to work considering a new formula, what are some key considerations that should be top of mind?
Sorry, I just I just couldn't get my. Can you hear me?
Yes.
Okay. Well, thanks very much, Bill, Larissa, and team for your great work on the GFSN tracker. It really does provide comprehensive and timely information on the components of the global financial safety net and the state of country access, and especially of developing countries. It was about, I remember, a decade ago, where we had to scramble to find out exactly who were receiving swaps and who had access to the various regional financial arrangements. So, and now it's all in one place. So congratulations. Now, while the GFSN has expanded and the number of participants has increased, as shown by Barbara, since the global financial crisis, the IMF remains at its center. So the IMF has broad, near universal membership. 190 countries can pool risks at the global level and provide a surveillance function, all of which are intended and will be helpful to promote economic and financial stability. Now, the presentation argues really compellingly for the need to ensure that the IMF is adequately sized and quota-based, so it is fit for purpose and can deliver on its global role, and that its governance is accepted as legitimate. these are essential directions of reforms towards a better rules-based multilateral financial system. So on Bill's questions, in my brief intervention today, I will offer just a few comments to the recommendations made, provide some observations vis-a-vis the ongoing 16th General Review of Quotas that will actually conclude in the next few days, and then close with some considerations as the fund moves forward with the 17th review. Now, my first comment is on the recommendation to expand IMF support for low-income and middle-income countries. Now, while quota shares determine access limits to IMF financing, the funding for the IMF's Poverty Reduction and Growth Trust, or PRGT for low-income countries, actually relies on other funding arrangements. These are more normally bilateral arrangements with countries, including SDR rechanneling and donor contributions to the subsidy account so that the IMF can lend at zero interest rates to low-income countries. And it's really quite important that, especially after the surge in demand, as shown by the presentation in the following the pandemic, the resources of the PRGT has been restrained enormously, actually, so that its future and the ability of the IMF to lend to low-income countries at scale will need to make sure the fund has to ensure that it's the funding for the PRGT is sustainable, and that the subsidy account will continue to enable it to lend at low interest rates or zero interest rates. And beyond funding, of course, as Barbara said, the quality of the lending. So another important longstanding ask from countries is for the IMF to explore instruments that can more rapidly deliver lending at times when countries need balance of payment support, and especially so during a systemic crisis. So there are some suggestions along the lines of more automatic financing mechanisms when there are systemic shocks and where the nature of the shock is not easily predictable, as we have experienced during the global financial crisis and the period of the pandemic. Now, second is on the allocation and use of special drawing rights, which is an important IMF instrument to boost liquidity. And the inequity of allocating new issuances of SDRs based on members' quota shares became quite clear in the 2021 SDR issuance of $650 billion. So then another instrument that enabled the IMF to lend to lower income countries in particular was the $100 billion of recycled SDRs or rechanneled SDRs, voluntarily rechanneled by countries that did not need the excess reserves. So it will be interesting to discern from the data in the tracker how the SDRs and their rechanneling could have increased access to IMF financing by low-income countries. Then the other beneficiary, of course, is the RST, or the Resilience and Sustainable Trust, that is meant to address shocks from climate change in the future. That too has been a beneficiary of SDR lending. So now, third, on what can be achieved under the 16th General Review, part of Bill's question. The expected 50% increase in quotas while maintaining the IMF's current lending capacity is will produce a notable change in trends since after the financial crisis. With the increase in quotas, the share of quota resources in the IMF's lending envelope will increase from 44% to 62%, and the share of borrowed resources will fall from 56% to 38%. Of course, there's still a long way to go to make the IMF fully quota-based, but this step has gone some ways to doing so. Nevertheless, the absence of a quota realignment is a lost opportunity. The out-of-lineness, or what you would call the divergence between the actual quota shares and the calculated quota shares, or what it should be based on the formula, has diverged a lot. And the last quota realignment was done in 2010, entered into force in 2016, and the lack of quota realignment in the current review will only mean that the gap has been widening, and that which will make future quota realignment actually more difficult. So one good news, of course, is the creation of the third chair for Africa in the IMF's executive board as a way to increase the voice and representation of low-income countries. So then my fourth and last point Let me close with some considerations on as the IMF moves forward to the 17th General Review, finally, the final part of Bill's question. The 17th General Review should of course aim for another major increase in IMF's quota resources, and this time commensurate to enabling the IMF to play its global role as the center of the global financial safety net. And to facilitate quota realignment, the IMF also announced its intention to come up with a revised formula. And a quick reminder that the quota formula now consists of a GDP variable and measures of openness and variability and vulnerability. So in this context, one reform consideration is to provide greater weight to GDP PPP, which will work better for emerging and developing countries, and is also a partial way to represent the importance of population. Now, yet another reform is to remove the bias from using both vulnerability and openness indicators, which are highly correlated and actually do not reflect countries' vulnerability to balance of payments shocks. So work will involve coming up with much better measures of vulnerability of countries from shocks that affect the trade and capital accounts, but also considering that it is not always to predict the scale or even the nature of the shock. Now, and more importantly, beyond increasing IMF resources, the review should also aim to reach consensus on a realignment that will enhance the quota shares of emerging and developing countries. So the role is not to underestimate the difficulty of reaching consensus, given the different interests of individuals and groups of countries, but consensus on a revised structure will clearly be very difficult. But at the global level, a shared understanding of the direction and extent of reforms among the major economies will be a good starting point. So let me end here, Björn. Thanks very much for including me in this panel.
Thank you so much, Mary Lou. Now, Marina, can you expand for us on the role of China in the global financial safety net, particularly as it relates to swap lines? There is some debate, for example, that swap lines should perhaps be counted as development finance in certain situations. Could you provide some clarity on this?
Sure. Thank you. First of all, thank you very much for the invitation to be in the panel. Yes, indeed, I think there is not much clarity, not only in the nature sometimes of what are swap agreements, but specifically in the role of China in the global financial safety net. In a nutshell, we could say that, of course, China participates in all layers of the global financial safety net. Not only it is one of the major key shareholders of the IMF, but it also plays a role in regional financial arrangements. For instance, China provide about 41 billion through the Shanghai Initiative, 76 billion through the contingent reserve arrangements, which is a regional financial arrangement between the BRICS countries. But also recently, China has increased its role as a swap providers. We know that since 2009, when the first swap from China was provided, which was from Korea, China has provided swaps to almost 40 countries. And we know for every 4 countries that China provides swaps, 3 of them are renewed. And just to an overall understanding of how swaps function, and specifically of the Chinese one, we know swaps are very short-term liquidity providers, liquidity source, and overall, when swaps are provided from China, they usually have a contract phase of 3 years that a central bank could access the swap arrangement, but it doesn't mean that they are providing a lending of 3 years, right? Within this contract of 3 years, the country can access a very short loan lending of about 3 months usually. So it's like an insurance that is less longer, but it's a very short liquidity provision. Today, and we know China recently has actually expanded the whole period of the swaps. So we have now China providing swaps that are, instead of 3 years, 5 years. In the case of Hong Kong, now it's the first Chinese swap that is provided a stand-up long-term without maturity for Hong Kong, which is similar, for instance, to the swap agreements that are provided by the Fed, right? So they are standby agreements. So and today we know out of 1 trillion that are available through swaps, we know that about 40% of them are provided by China. So what exactly is the nature of the Chinese swaps, and why there are some confusion regarding if it's a short-term liquidity or if should be accounted as something else like development finance. Here it's very important to understand they are very distant, different objects, right? While development finance loan is long term, is often connected to investment in infrastructure, health, or overall achieving a development goal, right? Swaps is completely different. They are short term. They are an emergency. They're much more connected to the nature of an insurance than a loan itself. So Chinese swaps, they are not the central bank current swaps. They are not long-term or infrastructure. They are liquidity when the system is when the countries need short-term external liquidity, right? So, but what exactly comes the issues where some people where the confusion actually comes from. I think the first we could say there are two main issues that could cause this confusion. First is some specificities of the swaps themselves, and second, the partners that the characteristics of some of the partners that Chinese provide swaps. So we know that although the Fed, the ECB, they provide often richer countries, they provide swaps to other high-income countries. China also provides swaps to high-income countries, but also to some middle-income countries, which is not the case. For instance, the Fed, with very few exceptions, the Fed provides, for instance, to Mexico and Brazil, but most swaps by most middle-income countries that receive swaps, they often receive swaps from China. And recently, we know that we've been facing overall debt crisis in the global south, and some countries because they don't have access to liquidity in the volume that should be sufficient, because the IMF is not in the size that it should be, because sometimes they don't have access to regional financial arrangements. Some of the partners of China that receives Chinese partners that receive swaps, they had to postpone to refinance their swap position. So this liquidity arrangement that should be a 3 month liquidity provision actually is becoming much longer than sometimes a year. But it's not exactly this is not exactly because the swaps are long term, but it's because the situation of the country required them to refinance this position. And this is for instance, the case of Argentina, that actually took a swap from China to bridge their position with IMF lending. So I think this is one question, right? Because it's not exactly the Chinese swaps are different from swaps from other countries, but because their partners were facing leading to a solvency crisis, and they need to refinance their position. I think another problem is that we don't have now, because we are facing a debt crisis, we don't have clarity on how swaps should be treated. So we have very clear in the IMF, they are senior creditors. So we know if the country needs to renegotiate their position, the IMF can lend because they are not going to. The IMF lending is protected. We know we don't know how to treat now swaps, because swaps are rather a newer instrument in the global financial safety net. We don't know exactly how they should be treated, and when a crisis hits, there may be concerns for China to provide them to the partners. More two questions that may bring to the confusion if it's a development finance or if it's actually the swap should be considered in the global financial safety net is the question of the currency, because Chinese swaps are in local currency, very similar to most swaps provided by the countries, with a few exceptions like Japan that also offer local currency swaps, but also dollar swaps. But most of them are local currency, and also the approach that the Chinese swaps, they are also provided not only for financial stability, but if the country needs to refinance trade, they also can use it. But I think what is important here is to realize is that money is fungible. So even if the country when we have an external liquidity problem, if a developing country can access swaps to allow the trade continues to be financed, it's also a way to mitigate the external instability of the system. So overall, just to summarize, I think China has been providing the Chinese swaps are not a bullet, the solution for the global financial safety net. We need an IMF playing a very strong role with more financing, with more conditional lending, but to some extent the Chinese swaps are filling this void of the global financial safety net. And their nature is not very different from other swaps. And yeah, I think I will end up here and leave for more questions later. Thank you.
Thank you so much, Marina. Barbara, you gave a great overview of the inequities across the GFSN in the serious gaps that exist. And obviously you've written about this extensively as well. Could you link this conversation up with the current state of financing needs? By all account, debt is at highly unsustainable levels across the globe. What are the implications of a GFSN that isn't sufficiently resourced and is inequitable? And what types of reforms are necessary to ensure that the GFSN is in a place where it can be responsive, sufficiently responsive to a truly systemic global debt crisis?
Thanks, Bill. I tried to be short because I already had the possibility to expose and leave time for discussion. So what we learned for countries in a financial crisis, and these are countries often with a higher level of debt, but not with an overhang of debt, that the provision, there are models of balance of payment crisis, how to treat them. And the important issue here is that a third party comes in, jumps in, and provides liquidity in a quick manner, in a voluminous manner, and easily accessible. That makes, for example, the Fed swaps, which are unlimited in volume time, so attractive because they are perfect for that. And the Chinese swaps are much smaller, for example. So this is what the global financial safety net in all its levels for all countries should provide in these three dimensions of velocity, of volumity, of volume, and of easy accessibility, adjusted to the potential reforms the country needs. So this contains financial crisis in countries and really brings markets back. When you look, for example, at low-income countries or lower-income countries, they already have, because they have such high debt levels, they have a fiscal space which is limited. In medium terms, they spend 2% of GDP in debt service. And in a financial crisis, this debt service increases because interest rates increase and maturities shorten. So there's even less money for education, social spending, etc., to cope with SDG goals, etc. So it's important that the GFSN provides this adequate liquidity to bring down costs of debt, to re-increase fiscal space. But there's another share of countries which are the over-indebted countries. And we learn from these balance of payment crises very, very clearly that a country which has an unsustainable level of debt, which has too high a level of debt, should not receive additional liquidity, but should get a debt treatment in terms of the lengthening of the maturities and of haircut to reduce the volume. So all the actors of the GFSN should be very clear and careful in not providing additional liquidity to countries which have a level of too high of debt. And there, all kinds of debt treatment nowadays probably linked to spending in climate adaptation and mitigation should come in. So yeah, I stop here.
Thank you so much, Barbara, Marina, and Mary Lou, for walking us through your responses to these initial questions. I want to open the discussion up to the audience. I'd ask a reminder to please submit your questions in the question and answer box within the Zoom functionality at the bottom of your screen, and be sure to include your name and affiliation. I think I'll start with the first two questions here that have come from the audience. The first one comes from Tarla Moses, the database manager and data analyst at the BU Global Development Policy Center's Global China Initiative. Why is it that access to different liquidity options vary by income level? What is the criteria for more varied access? And what is causing LICs to have less access to RFAs, central bank swaps, and other instruments beyond IMF financing? That's the first question. And the second question comes from Tim Herschel Burns, also of the Global Development Policy Center's Global Economic Governance Initiative. There's a school of thought that says IMF members with large quota shares will be reluctant to rebalance quotas unless they feel there is a credible threat that countries will move away from the IMF in favor of other crisis financing. What does the GFSN data suggest about the possibility of alternatives to the IMF emerging? And are there any such alternatives that are particularly significant? Those are the first two questions, and I'll open them up to our panelists today.
Should I start, Bill, or how do you?
Sure. Yeah. Do you want to take the first one, Barbara?
Okay. So this huge imbalances in the access to the GFSN come first from swaps, and swaps are provided by central banks based on their own interests. They don't look on a balanced global economy, on a world which is more equal. They try to settle the issues of their own financial markets, of their trade relations, and of other criteria. So this is one big chunk of the inequality. The national instruments. The second element is the different power and the uneven coverage of the regional funds. I have mentioned, for example, the European stabilization mechanism. High-income countries in medium terms are better insured because they have higher quota to share amongst them. And low-income countries have little to share. And there are also regions like Africa which until today don't have a regional fund. So there's also a need for creation of additional regional responses to address financial crisis.
Thank you so much, Barbara. Mary Lou, any reflections on IMF members with large quota shares and this reluctance to move away, or the kind of lack of a threat, so to speak, being why perhaps large countries are reluctant to really fundamentally reform and realign quotas?
Thanks, Bill, for directing this difficult question to me. Thanks. Well, it's well, IMF members, particularly the ones that would stand to lose from a quota realignment, will of course find it very difficult to agree, at least to a consensus shift of shares, if it will adversely affect them. So that is probably the more dominant school of thought on the quota realignment. Now, that said, you will need to increase quotas in order to actually to be able to undertake the quota realignment. Now, the hesitation on, say, the reluctance, perhaps, to increase quota shares as a regular routine, for example, might have stemmed from that the needs are being filled, in the sense that during the global financial crisis, the borrowing requirements kicked in, borrowing arrangements kicked in, the swaps emerged from other countries, and large countries like the US and China were able to provide that. So it is not so much a competition, at least from my perspective, among various providers of liquidity support, but rather whether countries with large quota shares believe that there is a gap that should be filled. That's my understanding of the debate behind the quota increases. It's always about whether there is need, the gap is there, or it's being filled, and whether there is need for the IMF to step up its quota resources. That's my brief answer. Thanks.
Bill, may I add shortly to this?
Absolutely.
What we try to do with our tracker is one important aim of is to wake up actors that the IMF is not alone. We have very different patterns of use of the GFSN, and it's not necessarily substituting the IMF, but using at least parallel sources. So the IMF already should be aware, and the contributors, the member countries should be aware that there's other sort of lending in liquidity crisis around it. So this is already happening to some amount. And this is happening to very unequal terms. Of course, the rich countries, the high-income countries, almost never needed to get access to the IMF, but they really built a parallel system where they're highly protected. And this is even harsher for the countries which do not have access to these club goods of really big regional funds and of these wonderful unlimited swaps, that they get even less covered. So the IMF really should start moving, I think. There is somehow competition in the room, and the system is getting more and more uncoordinated. Mm-hmm.
Thank you, Barbara. And Marina, one part of the questions that has been unanswered, if you'd like to reflect on it, is what does the data from the GFSN tracker suggest about the possibility of alternatives to the IMF continuing to emerge and in their viability? And are there any developments in that space that you see as particularly significant?
Yeah, well, for sure, what I think one aspect that is very interesting is that there is at the beginning, especially in the 2008, 2009, the provision of swaps were really something from developed countries to developed countries. So what we are seeing over time now is there is a support from the global south to the global south, which I think is a very interesting aspect. So we have swaps, not only China, but we have other countries in the global south supporting each other. It's also a sign, of course, that regional financial arrangements are not being tapped, and the IMF, that is, from some countries, some worries about accessing because of clarity and conditionality policies. But I see there is a growing network of global South cooperation, which I think is very interesting. Another aspect is that that is also the question of the regional financial arrangements not being accessed when they could be, right? So we have the case of Shanghai Initiative or others that we know that the existence of these regional arrangements and even the existence of swaps themselves are very important for financial stability. But even when countries need to access, they may be reluctant to go to the regional financial arrangements because some of them, they are also tied to having an IMF program or similar conditionality. So I think these two are things how we see the evolution of the global financial safety net.
Thank you, Marina. And I would add, in the case of take the Chiang Mai Initiative multilateralization, while we're not seeing the RFAs necessarily utilized the way that one would expect, what we are seeing is a tremendous capacity building going on. So last week I was at the ASEAN Macroeconomic Research Office's hosting of an ASEAN Ministers Forum. And really the topic of conversation was, how does AMRO, as the de facto secretariat and surveillance arm of CMIM, continue to develop capacity to spot risks on the horizon and to help countries in the APT region overcome the challenges that are on the horizon relating to debt levels, an aging population, and high inflation. And so really capacity development at the RFAs beyond just the actual lending is key to preparing these institutions to be activated in the future, but also to help countries at a technical level through regional collaboration and engagement. And I guess just one more question. Justine unfortunately did not provide an affiliation, but I'll pose it to all the panelists and then also offer each of you a chance to have a last word as we come to the end of the webinar. But Justine asks that LICs in particular face a lot of challenges that are, poverty, and health issues, and that these are exacerbated by climate change and those types of vulnerabilities. How can the GFSN help LICs to overcome some of these challenges in the future? So that's if each of the panelists could just give their concluding remarks, and if you have a reflection on that question as well, maybe we'll start with Barbara.
Okay. Well, there is an asymmetry behind that. We know from climate effects that the causes of the climate change are mainly rooted in the advanced economies, but the effects are mainly located in low-income countries in the global south. So there has to be an effort to rebalance these asymmetries, and the GFSN should play its role in providing liquidity, I repeat again, when countries are not over-indebted. And their liquidity provision could be much more generous and much less conditional, much less time-consuming, etc., much causing less administrative costs for low-income countries. And this would already provide some support. For other issues, there certainly is needed some additional funding in terms of non-credit finance of climate adaptation and change, etc. But these are.
Thank you so much, Barbara. And Mary Lou, over to you for your concluding thoughts.
Thanks. On the question of competing instruments in the GFSN, I mean, I'd rather believe that the expansion of the GFSN and the inclusion of many of other players and other types of instruments reflect the different needs at different times of countries. So the GFSN now actually provides different layers of support or different lines of defense. So when a crisis strikes, the presumption is you'll go to the RFA if you have access to it, and be able to gain access quite rapidly for financial support, then followed by, say, the IMF, who will then come in with additional support. So I see them more as various lines of defense that have developed over the years. Whether it's competition or not, that's, empirical evidence will probably be needed for that. But they they are a reflection of the different needs of countries. On the low-income countries, I mentioned the PRGT instrument of the IMF, which really is a very noteworthy instrument to be able to provide zero interest rate financing to low-income countries at scale. And it's calling now for a larger scale. The demand is clearly higher than what was anticipated. And I think that growing that instrument will be quite important for the future access of low-income countries, which is actually expected to, whose demand for liquidity support is expected to grow. Thank you.
Thank you, Mary Lou. And over to you, Marina. You're muted.
There you go. Okay, thank you. So on the leaks question, I think, well, leaks, when you talk about international financial architecture, so leaks not only need more access to the global financial safety net, but they need more access to development financing, right? So we need more aid, more grants, more concessional financing. And on top of everything, they also need more access to the global financial safety net. And I think this is especially now with higher for longer interest rate in advanced countries, and especially for those low-income countries and lower middle-income countries that now also have access to market, to issuing bonds, because refinancing this position, especially from them, is very tricky. So having access to a strong global financial safety net for them would be key now than ever. And of course, on top of this, we know foreign reserves are part of the global financial safety net, and SDRs are part of reserves. So I think especially for them, having new SDRs, having more access to SDRs that we know they demand very, very much, because it's an unconditional source of external liquidity is very important. So having more SDRs would also be key for low-income countries as part of the global financial safety net. Thank you.
Thank you so much,
Yeah.
Marina. A sincere thank you to Mary Lou, to Barbara, to Marina for sharing their thoughts with us today, and to everyone for joining this important discussion. This talk, as I mentioned at the beginning, has been recorded on YouTube, and we will share the link in the chat. To receive updates for these types of events and our publications, you can subscribe to receive updates from our Global Economic Governance Initiative, and we will also put a link in the chat. Thank you all so much for joining us today, and we'll see you next time.
See you. Thank you. Bye-bye.
Thanks a lot, Bill, for bringing us all together and for putting this up.
I agree.
And thanks to